Hey, in today's video, I'm going to be talking about the USDA loan. This has been one of the most popular videos on my channel because the USDA loan allows you to purchase a home with no money down. So if you want to learn all about this program, then you don't need to go to any other video. We're going to comprehensively cover everything you need to know about purchasing a home using the United States Department of Agriculture, USDA, Rural Development Loan. So we're going to jump right in. All right, so the first thing that I want to talk about is the benefits of the USDA loan. Why should you even pay attention to this video? So the best benefit of the United States Department of Agriculture's Rural Development Loan is that you can buy a house with 0% down. Now, you're going to also be able to get lower monthly mortgage insurance than FHA. That's an important key. And it's still going to have competitive interest rates. In fact, most of the time, the interest rate for USDA and the interest rate for USDA are the same. So if you're getting a rate that's completely different, you may want to shop around with a different lender. And the best part about it is it's not just a first-time homebuyer program, though if you are a first-time homebuyer, it's a great program for you because you can be a first-time buyer, but it also allows repeat buying when it comes to qualifying for this program. So here's what we're going to learn in today's video. So we're going to talk about who qualifies for USDA loans. We're going to talk about how income, credit, and property rules work, like what kind of properties can you get with this thing, who can qualify for it. We're going to talk about what costs look like, and this is going to be fees, insurance, closing costs, those types of things, as well as a step-by-step USDA loan process teaching you how to apply, and we will discuss some of the pros and cons and who the USDA loan is going to be the best loan for. So tap in, let's jump right in. There are two different types of USDA loans. Now you may not know this, but there is the USDA direct loan and there is the USDA guaranteed loan. Now I've done a video on the USDA direct loan. There's a video on my channel called USDA direct loans where I talk about this and I kind of go through the website. Here's the thing, most of this video today is dedicated to the guaranteed loans. Why is that? Well, the USDA direct loan is only going to be offered directly through the USDA. So as a mortgage broker or as a loan officer, I don't have access to that program, but I can tell you a little bit about it. So it is funded directly by the USDA. You would have to go down to your local USDA office to apply for this loan, and it is for very low income borrowers only. So most people are not going to qualify. A few of you will, and you're going to get an interest rate break. Obviously, it's a bit of a more lengthy process. It's going to take longer to close because you're dealing directly with the government. But again, you're going to apply directly through the USDA office. And so because we don't offer those loans, I don't have a ton that I can share about them. I do share more in the video in my channel, so I'll try to put that in the description as well for anybody that wants to jump into it. But that's the direct loan. It is for people making very low incomes. I believe it's under $30,000 a year. So the USDA guaranteed loan is the loan that's offered by people like me, mortgage brokers, lenders, credit unions, banks, right? And it's backed by the USDA. So what makes this program great is that you get to have the backing of the USDA. You get to have all of the benefits that brings, but you get to work with a mortgage broker or you get to work with a lender where the process is going to be a lot smoother, the process is going to be a lot faster. And this loan program is for low to moderate income borrowers. But don't let that fool you because of all of the programs available that allow you to purchase a home with zero down, USDA gives the most generous income limits, and we're going to talk about that later, so just stay tuned on that. But it is also the most common program, and it is offered by most lenders nationwide. There are some lenders that obviously that choose not to offer it. Some of your bigger banks, some of your online lenders are not offering it. But as a general rule, it is offered everywhere. What does rural, right? What does that word really mean? And it doesn't just mean farmhouses. I think that's the main thing we want to convey. Like, you don't have to buy a farm with this loan. The term rural to USDA usually means a population limit of under $35,000. So many small towns and outer suburbs are going to qualify for this loan. Big cities and dense urban areas are going to be ineligible. The pro tip about this, the thing that you want to remember is that if you extend your commute 15 to 30 minutes in a direction in whatever town you find yourself in, it often opens up eligibility for this program. So keep an eye out for that. So I'm based in Louisiana, so nearly every suburb in Louisiana qualifies, except a few like Metairie and Kenner and a few more. But in all of the states, right? Louisiana is a big USDA loan state. There's a bunch of USDA loan states out there. In all of the states, they're going to have areas that are eligible to qualify. And so if you want to live outside of the city limits in a major area, then this could be the right loan program for you. What does it mean about USDA property eligibility? So you can see right there on the screen. I'm not going to read the website out. I will link to that in the description of this video. But you can go to the USDA website and you can go to the single family housing guaranteed section and you can enter the exact address of the property that you're interested in, and it's actually going to tell you if it's USDA eligible or not. If it's orange, that means ineligible. Everything outside of the orange pockets or the orange regions are eligible for that USDA loan. And so obviously many of the suburbs just outside of metro areas are going to qualify. Now obviously the bigger the metro, right? You're talking top 10 cities in the US, the further out you'll probably have to go in order to be able to find something that fits. But in everything else, 15, 20, 30 minutes, you're going to be able to find pockets and areas that will qualify for this loan program. And hey, it'll get you out of the busyness of the main city. So who can use a USDA loan? That's another big common question that we get asked. Am I eligible for this program? So it's open for first-time and repeat buyers, right? It must be used as a primary residence and you have to live there full time. You cannot use a USDA to buy a second home. You cannot use a USDA loan to buy a investment property. It has to be your primary residence, and you cannot own another adequate home nearby, right? So they're not going to allow that. You do need to be a U.S. citizen, a national, or a qualified alien status. And as the time of I'm filming this videos, there are some changes happening in around what's happening with immigration. So before you pull the trigger, you definitely want to check and make sure none of the guidelines have been updated. So there are also, in terms of who can use the loan, some asset restrictions. So if you have enough money in your savings and checking accounts that would equal 20% down plus closing costs, you're not eligible to use this loan. So you have to have less than 20% down plus closing costs in a checking account. Now, typically your retirement funds are going to be excluded from this, right? Unless you're of retirement age and they're fully accessible to you. The goal here is to preserve this program for buyers who truly need 0% down. So this is something that's not easily Googled. This is something that you're not going to just find straight away, right? This is kind of one of those hidden guidelines that if you do have cash in the bank, you need to be careful, because if it equals 20% down, so if it's a $100,000 house, which those don't exist too much anymore, you would need $20,000 plus closing costs. So if you had $30,000 in the bank and you wanted to buy a $100,000 house, you're going to have too much in the bank to qualify. What does 0% down payment mean? And let's talk about closing costs. So what zero down really means is that it's no down payment requirement, right? So you don't have to put anything down in order to use the USDA loan. But that's for the down payment. You are still responsible for your closing costs. You're still responsible for your closing costs. Now, one of the things that's very important to understand is that your closing costs are going to be another typically 2 to 5% of the purchase price. However, this is really important. USDA allows the seller to cover up to 6% of your closing costs. So that's more than the 2 to 5% that they generally are, which means that a lot of times we have people that are getting the RD loan, getting this USDA loan, and coming out of pocket maybe $1,000 or less for the cost of their appraisal, for the cost of their home inspection, because they're, one, getting a good deal and negotiating with the seller to cover their closing costs. And I'll tell you too, that this is one of, if not the best reason to purchasing a home right now, is that most clients, right, most first-time home buyers are able to get the seller to cover their closing costs because there's just not a lot of competition out there. And so what are your closing costs? It's going to include things like your appraisal, which you do pay out of pocket. It's going to include things like title work, lender fees, insurance, taxes, government recording fees, all of those things. typically going to be between 2 to 5%. Where I'm at, you're typically going to see anywhere from $5,000 to $10,000 in closing cost on every transaction. Now, what fees does USDA have? So there is an upfront guarantee fee. This is similar to FHA. When you get an FHA loan, their fee is higher. It's 1.75%. The USDA fee is 1% upfront, but it's added into your loan amount. And so just to keep math easy, again, if you were doing a $100,000 loan, the fee would be $1,000, right? That's 1%. They also add an annual fee that's included in your monthly payment. So they don't call this PMI, but that's what it is. It's the lowest of any program. So FHA is 0.55, this is 0.35. They take that number and they multiply it times your loan amount. What that means is that your annual fee will decrease every year, but as your loan balance drops, but it obviously never falls off until the loan is paid off. So each year it's going to go down because you're making more and more payment towards the principal, but it never completely falls off. Oh, and here we go. I actually already had it in there. Seller credits, right? So just to reiterate, one of the great things about USDA, FHA, all the government loan programs is that the seller can contribute up to 6% of the purchase price towards those closing costs. And it can cover lender fees, it can cover the prepaids, it can cover the escrow account setup. Higher credits could, this is important, reduce the attractiveness of your offer in a competitive market. But again, like I just said, there are very few markets in the US right now at the time of this video, filming August 2025, that's the case. Right now is one of the best times to get the seller to cover your closing costs. It really, truly is. And so the other thing that you can do with the USDA loan, and this is something that you can't really do with any other loan program, this is unique to USDA, is that you can roll in those closing costs into the loan if it appraises for more than you purchase it for. So let's say you bought a $300,000 house and it appraised for $305,000. Well, that extra $5,000, you could roll closing costs into the loan with that. Now, it's a great benefit, but it's obviously not something that you can negotiate on because you just don't know what the house is going to actually appraise for. But it's a great benefit. If it does happen, you can potentially save some more out-of-pocket expenses by rolling anything left over that was your responsibility into the loan. Really, really great benefit, actually. Now, USDA does not have loan limits. So FHA, conventional loans, they have limits, right? The USDA doesn't do that. Instead, they have income limits, which is very similar to a lot of down payment assistance programs, even though USDA is not a down payment assistance program. And so how does USDA calculate your income? Well, it's got to include all members of your household. That's another thing that isn't always clear for everyone that wants to do this loan. If you and your spouse and you have an older son or daughter, let's say, and they work as well, or maybe a mother-in-law lives with you, like whatever the case may be, any income that's being produced by any person that's living in your home has to be counted. There's a form that you fill out when you're going through this loan where you certify that the only people making income are these people, and obviously you don't want to be messing around committing fraud with the government. And so anybody over 18, even if they're not on the loan, has to have their income included, but no, we can't use it in the loan, right? So I get it, but that's just kind of how it works. We use gross income before taxes, and you have to be under the program limit for the area and the household size that you have. So we're going to talk about that in a second. But yeah, that's a unique feature to USDA, is that they're going to make sure that anybody in the house that's working, you got to write their income out, and then they're going to ask for their tax returns to make sure that you're telling the truth. That's just how it works. Now, there are some things that you can do to adjust where you're at on the income limit. So you can deduct $480 per dependent from your income to help get under the limit. You can also deduct childcare expenses and certain medical expenses for elderly or disabled members in your home. And then adjusted income is used to determine eligibility. So once you subtract out all those things, that's when you can, that's the income that will actually be used for you. Now, there is also, just like the property eligibility that we talked about, there is also an income tool for the USDA. So I will do my best to link that in the description as well. It'll be on that same screen with the property tool where you can put in your income and it'll tell you if you're eligible based on your area and based on your household size. And then you can obviously compare your gross and adjusted income limits to those different program limits. But here's the deal, right? This is what you want to know. The income limits for most areas in 2025, if there are 1 to 4 people living in your household, and they're going to use your tax returns to determine this, if there are 1 to 4 people living in your household, then the limit is $119,850 in gross income, right? And if it's 5 to 8 people, it goes all the way up to $158,250. Again, we're using your tax returns to prove how many dependents live with you. These income can be higher, so there are areas where this is going to be higher, but this is kind of the standard limit, at least for sure in Louisiana and a lot of the same states that have the same kind of, they're not high cost areas. If you live in an area with a higher cost of living, you want to check because it might be 125 or it might be 130 compared to the 119. So your credit score requirements. Now, here's the deal. Officially with USDA, the official minimum is 500, but I don't think I have a single lender that will do that, right? Most lenders are going to require 640. We have lenders that will go down to 580. But the thing that you need to know is you need a 640 plus to get an automated approval, right? If you don't have at least a 640, and honestly, if it's not a 680, then you're probably going to be a manual underwrite. Now, the automated approval is an easier approval. The underwriter's going to ask less questions. There's going to be less hoops that you have to jump through. But just being honest, most people under 700 for USDA or have to go manual. And so a smart loan officer is going to pre-approve you based on you being manual so that there are no major problems down the road, as you go kind of through this program. So if you, unless you're obviously high credit, 680 or higher, then that may not be necessary. But if you're under that, then they really should be working it as a manual because 9 times out of 10, it's going to be a manual. So what is a manual, right? So a manual underwrite means that we're not getting an automated approval through USDA's GUS system, Guaranteed Underwriting System. So we have to process that file manually. And so what that means is that it has stricter debt to income limits where, we don't really know what they are on the front end for automated approvals. The back end, you're usually not going to get anything higher than 46.9. But with the manual underwriting, you're going to typically be capped at 41%. That's all of your debts plus your mortgage payment, or 34%. That's just your house payment divided into your gross monthly income. If that's less than 34%, you're good on that one. However, if you are a manual, maybe you had a bankruptcy or there's something that's making the loan become manual, but you have over a 680 credit score, you're going to be able to go up to 44% and still 34% on the front end. Now, the other thing to know, and this is kind of like part of that extra hoops you jump through, is that you have to have a 12-month rent history. And so we're either going to have to get a letter from the company that you rent from, or if it's a smaller mom and pop shop, we're going to have to get a letter from them and canceled checks. So you're going to have 12 months canceled checks or proof of Venmo or whatever that you've made those payments over the last 12 months. And the other thing is that it's going to require 1 month of reserves. So what a reserve is 1 month of your mortgage payment. So if your mortgage payment's $1,500 a month, after your closing costs are said and done, after your down payment is said and done, you're going to need to prove that you have 1 month, $1,500 in this case, set aside in your bank account. If your mortgage payment was $2,000, then you're going to need $2,000 set aside in your bank account. That's what a reserve is, and typically you're going to need at least one. Now, you also typically, every lender is different, but mostly the same. You want to make sure you don't have any late payments in the last 12 months. Sometimes they'll be flexible and give you one, but most of the time, if you have any single late payments in the last 12 months, you're going to automatically be ineligible for manual underwriting. So make sure you're paying your stuff on time. If you've had a bunch of late payments recently, you're probably going to have to wait a year or longer in order to be eligible for the program, unless you get your credit score up, right? And maybe you don't need to be a manual underwrite anymore, and then it won't be a big deal. The other thing to know on credit score requirements is the alternative trade lines, right? So let's say you don't have a credit score or you have a limited credit history. USDA does accept alternative trade lines. So typically rent history is one, utilities and phone bills can be another. You're typically going to need at least 2 besides rent to prove 12 months history of on-time payments. And then that's how you're going to be able to buy a house using USDA with no credit score. So if you've been on the Dave Ramsey game and you've been like not using debt and you've got no credit score, this is the way that you would need to do that. And the interest rate that you get is going to be based on you having like a 580 credit score. So that's just kind of how that works. Now, we talked a little bit about just a second ago debt to income ratios, right? So we talked about the front end and the back end. The housing payment, which is your mortgage payment, divided into your gross monthly income is your front end DTI ratio. I know we're getting real technical right now, right? That's your front end. Your back end is your housing plus all your debts. So if you've got a $500 car payment, if you've got $100 a month in credit cards, if you've got a $150 a month student loan, all of those get added together plus the mortgage payment, and then that gets divided into your gross monthly income, and that's when the 41% or the 44% kicks in. And so, right, automated approvals typically go up to 34.46. Manual approvals typically go up to 34.41, maybe 44 if you're over a 680. So yes, the limits on USDA are lower than FHA. They are lower than conventional. Now, just because FHA and conventional allow you to go that high doesn't, over 46, they're typically 50, even FHA can go to 50, 56, doesn't mean you're going to get approved for that. Sometimes, because we need it to be an automated approval, sometimes the real max for both of those programs is 50%. But every once in a while, you might get capped at 45 with FHA, or you might be able to go to 55. And so it really just kind of depends. But that is what it is for USDA. And what that means is, by the way, let me just back up. What that means is this is actually the secret number that determines how much house you can afford. This is what determines what you can get pre-approved for. So if you have great credit, but you have lower income and you've got some debt, well, we might not be able to approve you for anything more than 80,000, and you might not be able to find anything for 80,000. Versus if you have a low amount of debt or you have good income, right, you might get approved for more than you're even willing to spend. And so this is what determines that. So again, here's a great DTI example, right? You've got a $6,000 a month gross monthly income. I believe that's $72,000 a year. Let's say your housing payment is about $2,040 a month. That's your 34% max. And then your max total debt would be, $2,640, right? So that would only leave you $640 a month to have in other debts. Well, what if you had $1,000 a month in other debts? Well, then you would have to subtract $1,000 from this max here, and that would be your max mortgage payment. So in this case, it'd be $1,640 a month, right? That would be the max that you could qualify for. All right, let's talk about funds now, right? So we don't have to pay a down payment. We don't have to have a down payment. We don't need those types of funds. But if we have closing costs that we have to pay out of pocket, if we have a little bit of those expenses that we need to pay out of pocket, where can that money come from? Well, that money can come from a few places, and none of them are cash, right? If you have cash chilling in the bank, if you've got cash that is under your mattress, not chilling in the bank, if you've got cash not in the bank, if you've got cash under your mattress, not going to work, right? It's got to be in a checking or savings account. It's got to come from a retirement fund like a 401k. It could be a gift from relatives, but that will not count for reserves. That's important to know, right? And they can't be asking you to repay them. What's not allowed is unsecured personal loans, credit cards, like taking a cash advance off a credit card, or cash on hand, right? Everything that happens has to be documented, and typically cash on hand can't be documented. So you want to make sure if you're going to need $3,000 or $4,000 or $5,000 a month out of pocket, you just want to make sure that you have that in an account, and there needs to be some seasoning. So large deposits must be documented. So if you've got a $5,000 deposit into your bank account and it didn't come from payroll, right? We're going to have to prove where that money came from, and that can be a very difficult process, right? So it's best to have all funds in your account for at least 2 months before applying, and to avoid making any large non-payroll deposits. Oh. Looks like we duplicated that one. There we go. Let's talk about property requirements. We're moving right along. So what type of homes qualify? So let's talk about the conditions first. It must be safe, sound, and sanitary. It must have no major structural or safety hazards. Now, what does that even mean, right? The house has to basically be move-in ready. It has to be livable. That's what it means. So some common issues that you're going to find with USDA appraisals, and it's not really any different than FHA appraisals, is peeling paint, broken windows, exposed wiring, plumbing or HVAC issues, rotted wood or water damage, no heat, right? That's another one. if you have like if the property is elevated and there's more than I think one step, then the steps need to have rails. If there's a porch, then the porch needs to have railing, right? If there's anything like that, those are typically the things that I'm seeing getting called out on USDA appraisals. When it comes to restrictions on what type of properties you can buy, typically the main ingredients are going to be that they can't be income producing. So it can't be income producing land or buildings as the main purpose. So you can't buy like an income producing farm, right? Not going to be able to do that with the USDA loan. And acreage is allowed if it's residential in nature. So the main thing is because you're buying this as a primary residence, it's got to be a primary residence. It can't be a business. Now, I don't think I included this in here, but I know some folks are going to have questions about it. No, I didn't. What kind of properties can I actually buy? Well, most properties are wide open. You can buy a mobile home. If it's used, it has to be 2006 or newer, right? You can buy a townhome. You can buy a single family residence or a house. You can even, if somehow there were a duplex or something that was able to be purchased in a rural area, you could probably even do that. But you're not going to be able to buy any kind of big land or anything like that. So, but mobile homes are okay as long as they're 2006 or newer. All right, let's talk about how do we apply for a USDA loan. So here's a good step-by-step of how this happens. So number one is, 1A is watching a video like this. 1B is getting a pre-approval. You could obviously do that if you go to workwithchanning.com. Number two, right? Let me back up. Number one, we want to get pre-approved. Now listen, the pre-approval part of this process is not just so that we could get in your business, right? The point of the pre-approval is to give you numbers. It's to give you the monthly payment, the fees that are going to be required, how much is going to be out of pocket, and to just generally have a conversation with you about what you're looking to do to make sure that this loan program or whatever other loan program is actually going to be a good fit for you and your personal situation. So I know that a lot of first-time home buyers have a lot of nerves about getting pre-approved because they're afraid to be told no or they're afraid to be denied. And one of the things that I can say, I can't speak unfortunately for all lenders, but for us is we don't tell you no, we maybe tell you not right now, but we will always tell you how. And so when you work with a good lender, getting pre-approved looks like having a good conversation with them on the phone before you ever even do an application to make sure that you are, in the right space to even do that application. And then once an application is made, a whole other phone call is happening, preferably on Zoom, where they're actually outlining and showing you all of the fees involved, everything you're going to have to pay. So then after that, and not before that, which is what most people do, after that, you want to go look for an eligible property, right? A property that's going to fit the loan approval that you've received. You're going to make an offer and get it accepted. That's an important piece, right? And then you're going to get an appraisal and go through underwriting. So you're going to order an appraisal. Typically, that's paid out of pocket. It depends on your market. Generally, somewhere between $600 to $700, right? And the appraiser is going to go out there, and what their job is to make sure that the property is worth what it's being sold for. And then the loan in this process is also going through underwriting. So we're sending it to an underwriter, and then they're saying, hey, I have these questions about them. Can you have them answer this? Can you tell them to answer this? So on and so forth, right? So the underwriter's job is to look through all of your documents, all of your loan application, and make sure that it meets the criteria of this loan program. So don't be nervous when you go through this part of the process and they're asking questions and they're asking you to produce additional documents, because it's a normal part of the process. Once it's all been cleared from the lender, it still has to go to USDA. Now, very few and far between have we ever had USDA come back and ask for more. Sometimes they say, hey, I need a clarification on this. Most of the time, it's a formality. It's going there. It takes several days a lot of times because they have, obviously a queue of things that they've got to review. But they're going to review it. They're going to give you the conditional commitment, and then we're scheduling closing, right? So once it comes back from USDA, you're clear to close. We're setting up your closing. You go to the closing. You've now owned a home, right? That's a simple step-by-step process of what it looks like to apply for a USDA loan. Now, the USDA conditional commitment, I just kind of talked about that. They review the file after the lender approves it just to make sure it meets their criteria, which the lender is underwriting to their criteria, which is generally why you don't have a whole lot of extra stuff. but it does add some time to the closing window, and it can add, 1 day, 3 days, it can add 10 days depending on how backed up they are. And so we always tell people plan your contracts for 30 to 45 days to be safe. We have not had a whole big issue closing USDA loans in 30 days or less, but sometimes people do. And so if you're nervous about your lender because you're not working with us, then you might want to get that 45-day contract just to be safe. And again, that's a conversation you can have with your realtor. Now, are there any special rules with USDA? There are. So USDA is not going to allow any non-occupying co-borrowers, or what a lot of people would call a co-signer, right? Anybody that is on the loan must live in the home full-time. So you can't have like a mom or a dad co-sign for you even though they're not going to live in the house. USDA does not allow that. You also, in community property states, which I live in, you got to remember, even if your spouse is not applying with you, their debts count, even if they're not on the loan in certain states. And I think around somewhere close to half of the states are community property states. So important to remember that student loans, if they're in deferment, then we count 0.5%, that's half of 1% of the balance of your student loan as a monthly payment. And so if you have, X amount of dollars in student loan debt, we're going to take 0.5% of that and we're going to divide it by 0.5%. That's going to give us a monthly payment. And then we're going to put that into your debt to income ratio. USDA is also going to give you some, what are your refinance options with USDA? USDA gives you a few different refinance options that I think are really great. So one is the streamlined refinance. So that's the one where you're going to have a credit check still. So they're going to repull your credit. It's credit qualifying, to make sure that you still qualify. But both of the streamlined loans are not going to require you to order an appraisal, which is great. It's simply going to base it on the last appraisal that you received on the property. Now, the Streamline Assist is no credit check, no income verification, none of that stuff. They're just literally pushing it through based on the information they already have on you. No appraisals or anything like that. So those are two really great refinance options and abilities when it comes to being able to refinance that USDA loan. The other thing is, let's say you've had this USDA loan for a while and you've got some equity. Maybe the market that you're in went up. Maybe they started building around you, right? I've seen this a lot in like places like Houston and stuff like that, where the outskirts become the bigger and bigger and bigger over time because there's so many people moving there. When you've reached 20% equity or more, if you're considering doing a refinance, it's probably wise to consider a conventional refinance because it will remove the annual fee and it will remove the monthly fee with USDA. You won't have PMI with a conventional loan if you've got at least 20% equity. So that's what it looks like to refinance one of these things. Definitely something you want to consider. Who does USDA work best for? Well, anybody that wants a 0% down loan and is flexible enough to look in a rural or more suburban area. If you don't mind the commute in order to get a 0% down loan, this is going to be a great program for you. You obviously also want to meet all of the other program requirements and have steady income. That's another obviously important key. When to consider other loans? Well, if you're buying in an ineligible area, if you know you have to live inside the city limits, if you know you make way more than the income limits that are allowed, or if you don't meet some of the other programs, maybe you have low credit, maybe you have late payments, like different things like that, then you may want to consider other loans. But I'll say this, it's always important to talk to a lender. Don't ever just assume because you watched a YouTube video that you got all the puzzle pieces to put together. Definitely talk to a lender, preferably one that will, have a longer conversation with you and really dive deep to understand these things. Let them help you figure out if it's the right loan program, if you want to use it or not. So that has been USDA loans. If you want to see if you qualify, we're happy to help. You can always go to workwithchanning.com. And I'll do a lot of what I've been talking about in this video. I'm happy to have a 15-minute conversation with you, just understand more about you, more about your profile, more about your background, try to help you piece together what we call the Bayou Blueprint, right? It's the 6 steps in order to be able to purchase a home. We'll walk you through that and we'll walk you through all your options. So I would love to be able to do that with you. If you want to do that, like I said, you can just go to workwithchanning.com and that'll get you right there. Otherwise, thanks so much for checking out this video. I'll see you on the next one. Make sure you like and subscribe and drop a comment if you have a question.